Kitco Mining special coverage of Xplor 2024 is brought to you by Radisson Mining Resources.
Welcome back to Xplor 2024 in Montreal. I'm Ernest Hoffman for Kitco Mining. Joining me now is Michael Gentile, of course, founding partner of Bastion Asset Management. You're on several boards of several mining companies, and of course, a mining investor. So let's begin with the metals. We've heard from the company perspective from several people at this conference, and I'd really like to get just to start kind of with the market, because the market is driving, especially gold, is driving a lot of the sentiment. Maybe not a lot of the activity at this stage, but a lot of the sentiment has turned, and gold is a big part of that. Silver more recently. So we've seen a major run up in gold prices in the last year. We're up about 35% year to date, almost 40% over the last 12 months. So this is great news for mining companies. It's great news for gold investors. But a lot of people are potentially worried that they've missed the move, and they're wondering maybe how much could be left for gold in this bull cycle. So what are your feelings on where we're at in gold prices? You know, we're kind of approaching 2,800.
Yeah. Well, what a difference a year makes. I remember sitting at the same table a year ago with you. I think gold was between $1,650 and $1,750 at the time. So we're probably up about $1,000 an ounce since we last sat down here only a year ago. And I remember last year the sentiment was pretty dire, both in terms of the commodity and for the stocks. We've seen a powerful move, Ernest, in terms of the gold price, obviously going up $1,000 an ounce. But the sentiment for juniors remains pretty subdued still, which to me is an amazing opportunity. We were talking a bit earlier before but you're starting to see all the right signs that would indicate that this rally is going to broaden out. So the seniors are starting to rally, the mid-cap producers are starting to rally, the single asset producers are starting to rally, and most importantly for the junior sector is the development assets like the Skeena resources of the world are starting to rally as well. So that the last stage of the rally to really broaden out is that broader retail participation and the participation from the juniors who are still trading at very depressed levels. I don't get the sense, having followed commodities for 25 years, that we're in the euphoria stage. I was in a presentation this morning on a panel. I've never seen a commodity making new all-time highs like gold is now. And the level of apathy is still very, very high among institutional investors. Many of these stocks are still below their old highs from COVID. Many of them are, generalist interest is very low. Financings are still very subdued. So we're not at that stage where it's party time and everyone's talking about it and that's typically the end of the cycle. I think there's still a lot of wall of worry to overcome. And the valuations of gold stocks versus the S&P 500 are like 70-year lows. That's just like 1960 have we seen this valuation discrepancy. So if you look at gold on an absolute basis, equities, what they're pricing in, and relative to the market, we're still starting from extremely low levels. So last year I was really bullish on gold. This year I'm really bullish on the equities, starting to outperform gold for the first time in many years. We could talk about why. But I think there's a real opportunity for the equities to start leading versus the gold price, which has been happening the last year and a half, let's say.
That's right, and this is also, gold also tends to lead silver prices.
Yeah.
So last year we were talking, and the silver people were silver people were waiting for gold, and the gold people were waiting for the move.
Yeah.
Now, obviously, we've seen the move in gold. Just to get a sense from you, where do you think we are in terms of that move, the market price of gold, before we look at silver? How much do you think we've? Do you think we're, what is it, 70% of the potential gains? Where do you think we're topping out? I don't want to hold you to a time frame, but how much upside do you think is left in gold?
A lot of that's going to depend on where politics go in the next couple of years. So I think gold's been driven the last year and a half, let's say, or 2 years by reinserting itself in the monetary supply. So you're seeing these central banks from emerging market countries saying, we don't really have a lot of confidence in the US dollar anymore. We want to diversify our foreign currency reserves, so 65% US dollar, something way lower than that. And not having faith in other fiat currencies as well, you're starting to see big buying of central banks. That's what's driven the gold price the last 2-3 years for a very large degree, because the paper markets, the US investor markets have not been there supporting gold at all. In fact,
only until very recently.
They've been sellers, right? This last quarter is the first positive flow we've seen in years in gold ETFs, right? So if you have a view that the fiscal irresponsibility is going to continue and deficits are still going to be spiraling out of control globally, I think that trade is going to be on. If you see a major pivot, let's say back to the right, where austerity and cost cutting and trying to increase productivity and lower government spending, that could put a bit of a headwind on gold prices. But I don't really see that happening anywhere in the world, maybe except for like a Trump Elon Musk ticket in the US potentially could introduce that too, but that's a long way away from potentially happening. So I still think there's a big backdrop for gold prices continue to do very, very well. But like I said, to me, the real opportunity is in the equities, who are still pricing in the junior sector, to me, $1,500 gold, and the producers are probably pricing in $1,800 to $2,000 gold, where the gold price is $2,800. So gold price can go flat to down from here, and you can still have massive moves in these equities. They're going to play a catch-up trade. The free cash flow that these producers are generating now is massive. We were sharing tidbit. Agnico Eagle just based on my math, is generating more than $50 million of free cash flow per day at current gold prices. That's the market cap of 3 juniors per day in free cash flow. So the wealth the seniors are creating in this market environment is eventually going to trickle down to the juniors. And they are a depleting commodity, right? They decline their reserves, or decline every single year. If you don't buy new reserves or find new reserves, if you're Agnico or a bigger senior producer, your business is in jeopardy. So the buy versus build argument is also going to come into play. So gold, I think it's flat to up from here with a strong base support of kind of recycling and monetary supply. Silver, I think to me, I always said it's poor man's gold. So when gold makes new all-time highs and starts to capture the imagination of the mainstream retail investors, that's when silver typically does well. So I've been pretty cautious on silver the last couple of years until I really saw gold asserting itself. Now we're starting to see, with gold making new all-time highs, a little bit of broadening of interest in the sector. That's when silver typically does well. And when silver moves, it has explosive moves, right? Because it's a much smaller commodity, and a little bit of money in that sector can drive it much, much higher. So I think silver is going to play a bit of catch-up here, whereas gold will remain well supported, and both equities are trading at very attractive valuations, whether it be a gold equity or silver equities, a lot of value here for the market.
And you mentioned the central bank gold purchases. Do you think that the market has really digested the length of time? So central banks aren't getting into gold because the price is going up. If anything, that's not to their advantage at all. They're getting into gold because this is a long-term strategy. This is at least a decade, probably more, of them slowly reducing treasury holdings, increasing gold holdings. Do you think that the market? So it's being treated a lot as, the move was supporting this, but it was a kind of a steady move. Now gold is taking off. Now we have a lot. Exactly. Yeah. But do you think that the market has fully priced in the floor that this represents, that this is going to be steady buying for years? So even after investors pivot away from gold and back to something else, not necessarily because there's another hot thing, AI takes off again, whatever. Do you see that as a rising floor? Do you see that as just a floor that's going to kind of maintain gold at these levels? Or do you see that as a steadily rising floor regardless of what the broader market does?
It's a great question. So if you look back the last 40, 50 years, the central banks have either been net sellers or not buying gold, right? So it's a great point that you bring up, right? That physical bid. And you're right, the central banks, they say central bank XYZ, I'm at 8% of gold at FX reserves. I want to be at 15% in 10 years. And it's a robo buying, it's a long-term decision. They're not a hedge fund, they're not an investor like you and I who goes, gold's too expensive today, I'm not going to buy. They have their plan in place to diversify their FX reserves. They're going to buy gold whether it's 1,800 or 2,800. Do they buy a little bit less, a little bit more, depending on price? Yes, but like you said, it's a long-term plan. If you look at the price decks for the average big banks that run NAV calculations on the gold sector, they're still running with $1,800, $1,900 gold, even though gold is 2,800. And that's the part I think they're missing, is in the past you have these wild swings. Financial buyers, hedge funds are buying gold, ETFs, the gold price goes up, they sell, gold price goes down. It's a great point that you bring up, that physical bid is going to put an increasing floor every single year on the price of gold, and therefore the price decks the banks have to use should be structurally higher. And if you run those price decks, I've done it with my own math, the net asset value of these stocks explode like 2, 3, 4, 500% higher. So once that filters into the bank price decks, you're going to see, that's why I said the gold equity should play a lot of catch up here, and they are missing that element of physical demand. It's no longer a whipsaw market driven by financial players. There's a major physical bid in the market, and as you know, the physical supply of gold is limited, right? So when you have constant buying of physical gold in the market month to month, that soaks up much of the financial buyer's impact. And if they start buying like they are now, the gold price explodes higher. If they're sellers, there's a physical bid to soak that up. So probably less volatility.
And that's what we've been seeing since this started, and this is what people are puzzling.
Yeah, and the equity guys are still thinking it's the old paradigm.
Right.
Well, gold's 20. I don't believe it. It's 2,800. It's going to go back to 2,000. So I'm not going to buy.
The dips are so shallow.
Correct.
And then then there's a run, and then the dips are so shallow again. Yeah. And that's what I've seen. That's kind of become the popular wisdom, but I don't think the implications of it have necessarily been. That's right. So everyone understands now that central banks are providing a floor, and that when gold falls, it's an opportunity for central banks with a 10-year plan to just buy more at a slight discount, but they're going to buy it anyway.
Correct. And I was involved in the oil and gas sector in the late 90s. I remember when oil was $10, $12 a barrel, and the stocks were not priced against. Everybody thought oil was going to fall back to $5. They said the world can't survive $12 oil, $15 oil is too expensive. So the stocks were trading at huge discounts because the market didn't believe that $10 to $12 oil was sustainable. It's kind of crazy to say that now, right? Well, oil didn't go down to $5. It went up to 140. So not only did the stocks start pricing in 12, they started pricing at the top when oil was 120. They're pricing at 130, 140, $150 a barrel. So when you're starting life where your stocks are pricing in a commodity half of where it is today, and your outlook is flat to up from here, there's a huge catch-up trade to go there. And the free cash flow these companies are generating, that's going to be the big light's going to shine on the whole sector, where the generalist investors go, wow, there's real businesses here, earning a great return on capital, generating huge amounts of free cash flow, in an economic environment where every other industry is starting to slow down or roll over. On a relative basis, the gold producers are getting better and better from terms of fundamentals, while the rest of the market is softening. So that's a nice rotation trade you're going to see too, coming out of more traditional sectors into the precious metal sector.
And then silver is interesting because silver, on the one hand, you have a lot of new industrial demand for silver because of decarbonization, because of electrification, solar especially. But you also have the potential for remonetization, or at least for, silver as a monetary metal is getting a little bit interesting, not just for investors, but there is this idea that some people are going to want to hold silver. So, to what degree could we expect a potential rising floor for silver prices? First of all, they're benefiting from things gold isn't, which is, this is again a multi-decade build-out for solar, for electrification, but also, and we'll talk about copper in that context as well, but also just that this demand is only going to be increasing. So we've been predicting this massive supply deficit. It hasn't really been reflected in silver prices yet, even though this has been a few years that people have been saying, look, we're going into a massive supply deficit, demand's only going up, do the math. Well, how do you do the math on that front? Because do you see the potential for a similar, not exactly like the central bank move, but do you see the potential for a rising floor under silver prices driven by this increasing industrial demand on the one hand, and the potential for monetary or investment demand in the medium and long term?
So let's go back to your point on gold, and I use it to segue. Gold is reinserting itself into the monetary supply globally. At central banks, we talked about that. There's a physical bid that was present in gold the last few years that's not present before. Now, the difference between gold and silver in my mind is that if you want to diversify your foreign currency reserves and you want to move hundreds of billions or trillions of dollars out of US dollars into another currency, which is gold, you can't really do that in silver. So step one is gold becomes money again, and the central banks are telling you gold is money, and therefore the price of gold is being revalued higher to reflect the massive amount of paper money we've printed the last 15 years. So it's a catch up on gold. Silver doesn't have that reality. I don't see central banks going out and buying silver to stock in vaults because they can't get enough dollar value to make the foreign currency reserve rotation justifiable. Where it does become money, if the money is going mainstream globally in terms of central banks, if it goes to the average retail investor who now agrees gold is money, I've got to protect myself against massive money printing and the value of fiat currency declining. If retail says, I want to protect myself, they're likely to go buy silver. Because
silver is cheap money if gold is money.
If physical bid moves to retail, the retail is going to put a physical bid in the silver market that'll act similar to central banks. So that's the final step that you need to see, is that going mainstream, and that's when the stocks, the junior equities in the market will take off, and physical silver will take off, because they're going to want to protect themselves against that. But the physical bid, why I've had a preference for gold the last few years, that physical bid is real and not going away. If you see it going mainstream and everyone wants to protect themselves using precious metals, silver will do really well, and that physical element will be there, which has been present, on top of the supply-demand stuff you're talking about, solar and all that shortage of supply on the physical side. So silver's a bit of a hybrid metal. Some days it's a physical metal like copper. Other days it's monetary metal. For silver investors, they really want silver to reassert itself as a monetary metal. That'll be great days for silver investors ahead.
It's cyclical, right? It's going to be interesting. And to what degree do you see the Costco? Obviously, the Costco story. We're all very. It's interesting, but how significant is it? Do you see it as kind of the thin edge of the wedge of the average investor, and even in a way, the average consumer becoming interested in holding precious metals? Because the silver demand that you're describing, which is at the very retail level, first of all, it's more likely to start in Asia than it is in, say, North America and Europe. But we're already seeing this retail bid, physical retail interest in gold, and Costco's announced now they're going to be doing others. They're going into platinum. They have silver. So, do you see this as the beginning of that? Do you see this as just a kind of a Costco move and it's interesting? Or do you see this as Costco getting ahead of what could be a massive retail growth market?
Well, Costco are the best retailers in the world, so they've got really good indications of what retail is thinking, so I think it's a very positive thing. If you look at China, India, you look at Germany, why do Germans own so much physical gold, right? They lived through a hyperinflationary environment prior to World War II, where they learned when the value of paper money disappears, the only way to protect yourself is physical assets. So they have that history there. China and India have a long history of gold preserving their wealth, generational wealth for their families. I think what's happened with the cryptocurrency mania that we had And with the hyperinflationary period we saw in the US, a whole generation of investors, thankfully for us as precious metals investors, have been educated on how destructive inflation can be. We went through a 50-year period where inflation did nothing but go down. So a whole generation of people grew up saying inflation is not an issue. In the last 3-4 years, people are feeling it in their pocketbooks. It's expensive to go to a restaurant. It's too expensive to rent a house. It's too expensive to sustain yourself financially. So they're feeling it in their pocketbooks. They're seeing the value of their paper money dissipate, and life's getting harder and harder. And so and cryptocurrencies have taught people that fiat money versus hard money, there's a big difference there. So you've educated investors on the value of hard assets, and people are feeling the inflationary damages to their pocketbooks. So yes, I do think that Costco is the first tip of the sword of people going, I got to protect myself. Because every year my dollar goes less and less far. How do I protect myself? I can buy physical gold. And I think the more that goes mainstream, the more people have access to it, the more physical gold demand we'll have. On top of that, physical bank buying, which central bank we've seen is going to be a permanent fixture in the market. So yeah, I do think it's a very positive sign. And I think accessing precious metals is difficult for investors. You guys do it with Kitco, but it's hard for investors to access it. So the more opportunities they have to do it, the more you're going to be able to see that physical demand expressed with concrete dollars.
All right, and then how does copper fit into this equation? So we have gold, the monetary metal, the precious metal. We have silver kind of straddling the two worlds. Copper is technology. Copper is electrification. Copper is definitely a very big part of any of these massive industrial build-outs that we've seen. It's also a very big part of the electrification of the grid, of EVs, of solar. So, but copper prices, they're not as bad as, I took a look at them because, it tends to be, especially in the context of gold and then silver more recently, copper is doing okay over the last 12 months. It's not as bad as some people make it out to be. But where do you think copper is in this kind of lag between gold to silver and then copper really being an industrial metal and dependent on projections of these kinds of build-outs?
Yeah, I don't think copper is going to have an opportunity to participate in that kind of copper is money type argument, but I do really love the supply-demand dynamics of copper looking 10 to 15 years out. I'd say in the short term, we've had a slowing US economy, we've had a slowing Western economies, we've had a major slowdown in China, which has been a major headwind for copper, right? So copper is really going to be a traditional base metal economy supply-demand. So we have a massively short supply situation for copper going out 10 years. In the short term, it's how's the economy doing month to month that drives a short-term supply surplus or deficit that's going to drive the copper price. But you're right. If you look at look what oil's doing. Look at previous slowdowns in the economy. You would assume copper would be $2.50, $3, but it's been firmly above $4 for the last year, right? So that tells you the market's slowly starting to price in the long-term supply shortages that we're going to have. But to me, the short-term driver for copper is going to be how's China's economy, how's it going to turn around, and what happens in the US in terms of the economic acceleration or deceleration that we're going to see in the next year to two. So there, I'm a little bit more cautious. I like projects that have copper and gold together because gold becomes a very nice sweetener for these copper projects. I love the long-term outlook, and I think we need much higher copper prices, like $5, $6 copper prices minimum, to justify new capital builds to fill that supply deficit we have in the future. So it's a bit more of a trading metal, I guess. Short-term, it's been more volatile, but long-term fundamentals are excellent. And if I get an opportunity to buy it on a discount, I'm very happy to do it because the supply picture is very, very good there.
Right, and that's a very, very steady supply picture in terms of everything we're already planning to build, everything fully priced in that we need to be building and that we're fully committed to building is going to need a lot of copper.
And by the way, everything we've built in the last 5 years has gone massively over budget. So the cost per pound to add new copper production is understated in my view, and that's why $4 copper, when you run the IRRs of these projects, capital divided by return, it doesn't work. And all the major mining companies are telling you that. That's why all the major mining companies are buying producing copper assets, because they'd rather buy cash flow now than sanction their growth projects, because the returns and the risk associated with building a project at $4 copper with cost overruns, delays in permitting is not there. So you need to send a much higher copper price, or we're going to have to rationalize demand. So you have to pivot away from EVs or have governments, rationalizing their support for the industry, because it doesn't work. If you run the numbers 10 years out, we are massively short copper. So we either need higher prices or we got to pivot on our EV strategy. It's not going to work without it.
Okay. So then let's drill down into the equities a little bit. So we understand what's happening in terms of the moving, the metals, what's moving, what's kind of dragging it up, what could potentially overshoot, what's short term versus long term. How does that work? How are you seeing us in terms of this cycle for the equities? So, like you said, majors are now flush with cash. How long do you think before this really impacts? I guess the mid-tier are also there. How long before the juniors and many of the companies we're seeing today? How long before they're essentially forced to invest in the juniors.
So you've gone through a period where the majors have done very little exploration, spent very little on new projects. So their cupboards are essentially bare. And you're starting to see it very encouragingly. You saw Filo Mining get taken out. You saw Osisko Mining got taken out. We saw Rio Tinto do major exits in the lithium space. So I think we're getting quickly to a point where the company's generating a lot of free cash flow. Their stock prices have recovered, so they have better currency to do deals. And now they're going to go to their teams and go, we have to do something. Are we going to build or are we going to buy? And building in the exploration space, I often do the maths. I'm heavily invested in the junior exploration sector, as you know. You can go out and buy gold resources today at $5, $10, $15, $20 an ounce. Or you can task your team at one of these major mining companies to go find something new. And if you add all the cost of their G&A and their geology team and the cost of dry holes or missing deposits or not finding anything, you're probably talking $80 to $100 an ounce discovery costs all in by the time you find a deposit that's worthwhile. So you can go find it, take 5 years to drill it out and spend $80, $100 all in, or you can go buy it for $15 to $20 an ounce in the ground. I think that's a pretty easy discussion and decision for the senior mining companies to make. And now that they have the cash flow to do it, and the equity prices remain so depressed today, it's a no-brainer, right, for them to do it. So I think you're going to start to see a lot of M&A. We're seeing all the senior projects, the very advanced ones that are a year or two away from permitting, getting snapped up. So that cupboard's almost completely bare. So now you got to move down cap. You got to move down to the PEA stage projects and the resource stage projects. And by buying those, you can jump ahead 5 years versus doing grassroots exploration. And it's a very low cost. So I think we're going to see a major M&A cycle. Either the market's going to correct it with the equities rallying to better levels where they can finance themselves and move their projects forward, or you're going to start to see a wave of acquisitions. So like a Nico Eagle doing $50 million of free cash flow a day, they could buy a junior every day in the month of November and still have a clean balance sheet at the end of the month. And I don't think they're going to buy 30 juniors, but you start to see them splashing their cash around. Investment in ATEX, investment in forehand mining. I think more and more seniors are going to start to do that in order to have a pipeline of projects to keep them in business 20 years from now.
And I know nobody likes being held to time frames, but you're one of the people who's best positioned to at least float something out there. So when do you think, so you're giving some kind of leading examples of majors that are taking a stake or that are showing signs, but like you said, they could afford to do it every day, every month. And when do you think it's going to become a kind of a positive cycle where they're essentially competing with one another for the better junior stakes?
So another interesting tidbit for me is you read the circular, Gold Fields bought Osisko, right? And Gold Fields is a 50-50 JV partner with Osisko already. So in the eyes of myself and other sophisticated investors, the logical buyer for the other 50% of that asset was always Gold Fields. The perception on the street was it's a captive asset because most major mining companies want to own 100%. They don't want to do a 50-50 JV with their mining company. So Gold Fields came in and paid a 70% cash premium for Osisko Mining. We said, why the heck are you doing that if you're the logical and only buyer? If you read through the circular, there was 2 or 3 other bidders in the room that wanted to buy just the 50% stake in Gold Fields. So that tells you, even though Gold Fields was the logical and likely only buyer of that asset, other major mining companies were willing to come in as a 50-50 partner just to get a piece of that asset in a good jurisdiction and close to production, right? So you're already seeing it. And what happens is once one company does M&A and their stock doesn't go down and the market applauds them or cheers them on, all the others are waiting in the wings to do that. And that was a nice tell for me that other companies were in the data room. If they're looking at Osisko, they're looking at a lot of other things. That's why you're starting to see more tension. You're starting to see very high cash premiums, which is indicative of competitive processes. And so I think it's already started. I see it on my juniors when I'm working with them. The corporate interest in my juniors has never been higher. They're kicking the tires with good questions. They're coming prepared to meetings. Sometimes you go to a conference and the corporate development guy or girl, it's their job to kick the tires. So they're kicking the tires, but they don't want to buy the car. This year I've changed the tone. They're kicking the tires, come with a list of 20 questions. They're ready to do something. And the level of engagement is much higher.
The selection process.
Right, exactly. And so once you see a few M&A deals in the junior space, that's going to permission for other seniors to do it, and all the stocks will rise on the back of that. You saw the developers all take off like rockets when Osisko Mining got taken off, because all the other developers that were less said, okay, we're going to get revalued higher. The same thing hasn't happened yet in the junior space, but I think we're very close to those 50, 100% all cash takeout bids in the junior space. That'll start to lift the whole sector, and other seniors will want to follow before the window closes. Right. Because they're cheap now, they're not going to be cheap forever.
Okay. And then so 2025, do you think that's the year that this process you're describing, like, are we in the middle of that process by the end of 2025?
Barring some major event that dislocates the gold price or dislocates the global economy, I think we're already seeing it happen. We're seeing the M&A pick up. Yes, I think it's good. Last year I was here saying gold price has to go up. The sentiment is so negative. I'm here today saying that we're going to start to see the gun's been fired, starting line's off, and they're going to start to see a lot more M&A down cap. And not just merger of equals we saw in the seniors, but buying of junior resource projects. Because again, it's so much cheaper to buy than build. To me, as an economic-minded person, it makes no sense not to do it. And once that happens, all the other juniors will start to lift, and you'll start to see a much better participation by retail in the sector going forward.
Okay, and then this is something I wanted to ask you about, because you're one of the people who's uniquely positioned to think about this. How do you value? Because what you're describing is a process of many of the people at these majors haven't done this in a little while. They're going to get back into this space. They're going to be looking at a lot of competing claims. They're going to be looking at a lot of management teams. How do you value junior mining companies from the perspective of someone who is willing to go there when the majors aren't necessarily, and who presumably has taken some lumps in terms of learned some lessons by getting in early and dealing with companies that are not quite there yet? So what are the keys for you for getting into the junior space?
It's a great question. So I've spent 25 years institutionally managing money for larger institution pension plans, and there I was always investing money in cash flowing, mid-senior producers. So I've kind of learned how they think. I've also seen over 25 years the kind of mines that get built. So even though I'm making an investment in a $5 million market cap junior, even if it only has 5 drill holes in a deposit, or maybe not even have a resource yet, I'm already thinking, does this project have the attributes to be a mine one day? So to a certain degree, I'm thinking like a senior. Does it have good grade? Does it have scale, good jurisdiction? Does it have a good management team? All those attributes that will make the project potentially economic one day. So when I look at them and say, even if it's early on, I want to say, does it have a chance to be a mine? And then if it has a chance to be a mine, well, what's it going to cost to drill it out? And what's it going to cost infrastructure-wise to put into production? And you take that capital cost, look at the gold price, look at the acquisition cost. Again, is it cheaper for a major to buy the ounces, put the capital in the ground to be producing gold? And what's the margin left from it at the end of the day? It's a very simplistic kind of mental calculation, but that gives you a good indication of what you're able to pay per ounce in the ground. To give you an example, stock XYZ trading at $10 an ounce in the ground today. Can you afford to pay $100 an ounce for the resource? Put $1,100 per ounce as a resource into capital to develop the mine, you're still left with $1,500, $1,600 of margin in today's gold price. So the price you're willing to pay for the ounces in the ground today is a direct function of how much it's going to cost to bring it to production. So I'm always thinking like a senior, thinking like an owner, not just a renter of these stocks. And I can tell you right now that build versus buy argument, the buy argument is very, very powerful. But you've got to be in the projects that the majors believe could be a mine. There's no red flags, there's no showstopper that's going to prevent it from going into production one day. And if you're well positioned, you're patient, and you preserve the capital structure through the downturns, the returns will be there for the rest of the other side of the rainbow.
Okay, and then you seem to be describing a situation where there is no scenario where a major would find it attractive to build versus buy. What's the other side of that? Do you see scenarios? What is the scenario? Just for my own, I'm just curious. Yeah. Under what circumstances would a major just go into that space and go after?
So build their own. I would say brownfield projects are obviously very favorable. So if you're a major, what you're going to do is you're going to, let's say a mine's producing 200,000 ounces a year currently, and they've got excess mill capacity and you've got exploration upside. Well, the logical thing is to leverage that mill as much as you can and go from 200,000 ounces to 400,000 ounces without putting additional significant capex in the ground. So the majors will exhaust all of their brownfield development opportunities for sure. They're also going to look for near mine opportunities. So I have a very strong preference when I invest to find deposits that are close to existing infrastructure already. So the mill is already out of the question. Those are going to be prime takeout candidates, because building a new mill in northern Quebec or a new mill in Ontario or Africa, anywhere, it's very capital intensive. So you're going to exhaust anything close to mill first. Once the mill is full and you've got enough resource to keep that mine open 15, 20 years, then you got to go more greenfield. So definitely they're going to want to do brownfield first. But I'm telling you, when I look at these companies, their brownfield opportunities are limited, and their depletion every year of the reserves is pretty extensive. So they're going to be out of options pretty soon and forced to fill the pipeline with greenfield opportunities. But they've got to be in favorable jurisdictions where they can earn a good return. That's going to be the key differentiator for them. Okay.
And then you've already mentioned, obviously, 2025 looks like a very good year for M&A, for the juniors potentially. Or very likely. What else are you focused on for 2025? What are some opportunities, and what are also some risks? Because it sounds like a very sunny scenario right now, and we have reason to believe that it is. I mean, we were here a year ago. You've obviously been in this space for a long time. But what are some of the risks? It sounds like we have a rising floor under. We have at least a long-term, very, very positive scenario for industrial metals like copper. We have a rising floor under gold. We have multiple drivers that are going to be helping silver. Where do you see the risks here on the metals front and potentially in the equities? And what are some of the opportunities that we haven't really addressed for the coming year?
Yeah, so I think a lot of our macro discussion has been on the medium to long term, right? Say like the next 2 to 10 years, we have a very positive backdrop for demand in gold. If we're calling 2008, right? If you have a major market dislocation, like a global financial crisis or a major stock market crash, gold equities are stocks first, right? So if the stock market's in free fall, we have a major crash, it would actually increase the positivity for the sector going forward because you need central bank intervention, more money printing. But in the short term, these stocks are all going to go down. So if you're worried about a major market meltdown, like the S&P 500 or the tech sector rolling over, in the short term, it would be negative for gold equity. So I'm not here to say that come any scenario, gold stocks are going to do well. If that happens, it'd be very negative. And like I said, a major political shift, which goes from deficit spending, printing money nonstop 24/7 to more of a fiscal austerity, fiscal responsibility, that could put a dent in the price of gold. So those are two things you want to look out for. But besides those two things, where the valuations are today, where the gold price is in our discussion, this sector is probably the best risk reward I see in the market. I look at all sectors in my professional endeavors here. It's probably the best risk reward you can have in the market right now. So I would say major market dislocation or major change to the political landscape that puts austerity on the table would be the two things that would dislocate the market, in my opinion.
Okay. Well, thank you very much for joining us today. It's been we covered a lot of ground, and I think there's a lot of value there.
Thanks a lot. We enjoyed it.
Thank you. I'm Ernest Hoffman for Kitco Mining. Stay tuned for more coverage from Xplor 2024 in Montreal.
Kitco Mining special coverage of Xplor 2024 is brought to you by Radisson Mining Resources.